Welcome to the video blog. As you can see, the topic for discussion today is volume spike for high probability trading opportunities. Now, you would have heard or read a lot of blogs on the volume being a key indicator for trading opportunities, but this is slightly different. So I would request you to hang on to the end so that you can understand the key importance of volume spike or the sudden change in the volume of an underlying stock or ETF as a trading opportunity. But before you go there, I'd request you to have a read of those disclaimers. Those are very important for any trader in financial markets to understand exactly what are the risks and what are the rewards. And I would like to emphasize that it takes some time to go through it, pause the video as and when appropriate, and go through it. So before we get started on the topic, just want to introduce by saying that a trader or a investor looks for an appropriate opportunity to buy or sell an underlying stock or ETF. Now, for a trader, it's important that he or she looks at the chart to time those decisions appropriately. So this is a chart of an underlying stock. It is one of the stocks it could be from anywhere else in the marketplace in the world. It could be Asian, it could be European or whatever. Just look at the chart. It's a simple candlestick chart. But if you look at this chart, then you can see that there are three key criteria or three key aspects of the chart. And these aspects are basically, or key dimensions are basically the time of the year. Now, time of the year is, as you can see, it's at the bottom of the chart with the box highlighted for you to understand. So that's the time of the year. The second dimension is the trading volume. Now, that's going to be the subject of our discussion today, but this is highlighted here in the pink box, the purple box at the bottom, which basically means the volume of the underlying traded on a particular day. And this is a daily chart, by the way. And the third is the price action, which is basically the way the price moves with the passage of time. So every day the market is going up and down, and these are tracked by the chart, and you can see that the stock is moving constant up and down every day when the market is open, and leaves a pattern in terms of how the stock has moved for over a period of time. So that's the price action. So just to summarize, there are three key dimensions of a stock chart. Now, as mentioned at the beginning, we're going to look at the volume spike or the sudden change in the volume as our key criteria for discussion today. Now, often I have noticed, or for many traders, they do not look at the volume of the underlying, and it often goes unnoticed. But it's such an important decision or important criteria for making buy or sell decisions. And most of the time, many of the charts actually do not show volume. You have to enable it. So by default, the volume is not being shown in some of the trading charts, and you need to enable it. So it doesn't get the importance that it deserves. I'm just going to show you again the volume where it is being shown in the trading chart. So you need to enable it basically. So if you enable it, this is what it looks like. So this is a stock chart of an underlying. It could be from any of the stock markets around the world. But look at the bottom of the chart and the box. As you can see, there are volume information in the chart itself, and tells you that how, as the stock traded, what was the daily volume of the chart on the various days of the period of the chart. Now, as mentioned to you, the spike in the trading volume of the stock has immense significance in its future price movement. Now let's see a couple of examples here. So this is the charting software I often use for purpose of my trading, and I still use it in spite of having additional tools at my disposal. But just for the purpose of explanation, I just wanted to show you a few examples. So these are the stocks from UK, but doesn't matter. Exactly the same phenomenon happens anywhere else in the world. It could be in Australia, it could be India, Singapore, US, or Brazil. It doesn't matter. Just try to understand the concept I'm trying to just talk about right now. So here is a chart for one of the underlying in the British market, and you can see there is a huge spike in volume. So the average volume is much low, and all of a sudden there is a spike. And following the spike, the stock traded pretty much in the sideways, and just on the last day of trading, it just went down. Here is another example, but this example is probably not appropriate. So let's move on to the another example. So here is another interesting chart where the volume has been generally trading very low, very low. Then all of a sudden there is a sudden spike in the volume, and after the spike, the 2 consecutive days of spike, and the stock sideways traded for a couple of days and then moved up. So here is another interesting example of another British company. On the day of this spike, there is a huge price movement, as you can see, the top of the candle at the bottom of the candle, and following which the stock actually kept on moving up and up and up and up. And for all consecutive days, as you can see, the stock had moved up. I'll give you a couple of more examples so that you understand the point. Here is an example where the stock, following the volume spike, the stock has actually plummeted. It has gone down, and as of last trading day, the stock has gone down. So basically, the key information I'm trying to give you here is that as the volume spike happens, or there is a sudden change in the volume, the stock can actually go up or down, or can trade sideways. Now, going back to the presentation here, there are a variety of reasons as to why there is a volume spike. I mean, you need to understand, then that gives you the indication of why you should use volume spike or sudden change in volume as a indicator for your future trading decisions. Now, various listed companies undergo consolidation. Like, for example, one company buys another, one company merges with another, and that keeps on happening in all the stock markets around the world. And as it happens, the number of top stocks available for investment also changes. And also at the same time, new companies being listed, as you hear about the IPOs being launched for many companies. So as new companies are introduced in the stock market, obviously there is a enthusiasm about investing in that company. So money is pulled out from an existing investment and moved to the new IPO investments, as an example. So what happens is investors are always looking for stocks or ETF where there are higher returns. Now, as a result of that, the money is actually constantly moving from one stock to the another, one ETF to the another, or stock to ETF, or ETF to stock, or from one asset class to another asset class. For example, gold to stocks, or stocks to gold, and this keep on happening all the time. This movements doesn't happen in only one country. It's happening around the world almost all the time. The most significant contributor to the sudden change in volume or the spike is the flow of smart money. Now, let me talk you through what exactly smart money means. Now, smart money is the fund managed by institutional investors, central banks, hedge funds, and financial professions. So, as you can imagine, these are not retail traders; these are professional traders. You can understand from institutional investors, central banks, and the likes of those. Smart money managers, they are sitting on billions of dollars of fund or equivalent currency in your country, and they have a better chance of their success of their investment because It is managed by people with expert knowledge. They have more knowledge than a retail trader has. So expert knowledge actually comes from a very detailed analysis of financial markets. So what they do, they hire equity analysts and specialists who analyze every stock and ETF available in the marketplace, and they pick certain stocks that they think are best suited for their investment, for the best return they could get for their investors. So, so what happens is because the smart money has got expert information or expert knowledge of their decisions, so they have better understanding of what the stock is headed in longer or short term. Now, that level of analysis is extremely difficult for retail traders because it's a very time consuming, expensive process, and you need experts to go through each and every stock and ETF to make a decision as to whether or not this has a potential to for the stock to go up or down, and accordingly they make decisions, which is very difficult for retail traders because either there's not enough time or that there is not enough level of understanding and knowledge. And third thing is there could be other considerations which is not available to retail traders. So this smart money managers, what they do, they keep on balancing and rebalancing their portfolio. So they keep on moving their investment from one stock to another to make sure they can get the best possible return for the money that they're investing. As the money moves in and out of stocks or ETF, there is change in volume. The volume goes up, and because they have big amount of money, the volume of stock they can buy or sell is pretty big, and they can have an impact on the trading volume of a stock, and they do. As you have seen in few examples, these are mostly caused by big sells, which are done by large funds or large other people with large volume of money. So either way, as and when the money keeps on moving, the volume goes up, either buy or sell. Now, what it basically translates into that when this buy or sell, obviously if this sell, there is a potential that the prices goes down, and if there is a sudden buy, then the prices might go up. But we as a retail trader do not know exactly where it is headed. There is a volume spike. Yes, the volume has gone up, but we do not know necessarily that the volume spike is caused by a buy or a sell. Anyway, we'll get there in a minute. So as this buy and sell goes around, the stock prices keep on going up or down. This buying frenzy goes on across stocks on ETFs, and this manifests into the spikes, as I just mentioned to you, that the volume goes up and down, and there is a spike in the daily trading volume. For a retail trader, it is difficult or impossible to monitor the market on a continuous basis. I mean, either we can have a look at one or a couple of stocks and see if the volume has gone up or not, and then make a trading decision. But generally, across the whole portfolio of, say, for example, ASX 200, which is 200 stocks, or ASX 300, or for example, FTSE 100 or FTSE 250, which has got 250 stocks, or S&P 500, which has got 500 stocks. It's difficult for a retail trader to be able to monitor as many number of stocks. You could perhaps do one or two, but you're not looking at the whole market and not looking at the whole the width of the opportunities that could potentially be available to you. So the key for us is to figure out as to the volume spike that has just occurred. What does it mean? I mean, is it a buying or a selling? Has it happened because of the buying pressure or a selling pressure? We don't know that as yet, but let's keep on going and you'll figure it out. So our key interest as a trader is that we need to find out that particular spike that has happened in the underlying ETF or stock. Is it a short term, or is it what would it translate into? Is it going to be a upward movement of the stock, or it means a sell off, which means the stock prices or ETF price is going to go down? So the question is it a bullish opportunity or a bearish opportunity or no opportunity at all? Bullish, obviously, you're expecting the price to go up following a spike. Bearish, of course, the price is going to go down, or it is no opportunity. That means yes, there was a spike, but there was no significant change in the price. It probably traded sideways for next 2 or 3 months. Each of those opportunities are actually tradable. If you know it is a bullish, you could trade. If you know it is a bearish opportunity, you could trade. If it doesn't make any movement at all, it just stays wherever it was, or it trades sideways, you can still trade that opportunity. And there are various ways to trade it, not subject of this discussion, but you could potentially trade when the stock is going nowhere. So here are a couple of examples, just for again discussion again. The Compass Group in UK is a London Stock Exchange CPG. The After the volume spike, the price has gone up. As you can see, there is a massive upward movement of the stock price after there was a spike. Suncor Energy, that's a Canadian stock. The stock declined sharply after a volume spike. As you can see, the volume spike happened, marked by the purple arrow, and then the price fell sharply, although it recovered later. But the immediate impact was that the price sold off, or the stock sold off pretty big time. Westpac Banking Corporation, that's an Australian stock. Stock chart is WBC, and it traded in a narrow band after a volume spike. As you can see here, the spike had happened, but yeah, stock declines, recovered, and that pretty much traded sideways. So basically, one of the three things can happen once there is a volume spike, or there is a sudden change in the volume. Either it goes up, or it goes down, or it moves sideways. Now, the question is, what is the probability? The probability is a word that I would recommend the traders to remember all the time, because all you have got while trading in financial market is probability. So you go by probability, and that's the big mantra that Sapphire Capital uses in all of our discussions. So the question is, what is the probability? So if there is a volume spike, what is the probability that the stock is going to either go up or down or sideways? Because all these informations I can trade if I know what's the probability. So what is the probability that the stock is going to go up or down following a volume spike? By how much and in how many days? What is the historical evidence of the stock going up or down or sideways? Now, as a trader, you would have heard about the back testing all the time. Now, back testing is great. That's what we should be doing. But here we are relying on not only back testing, but complete historical evidence of every time there was a spike in last few years, what happened following that. So that is my statistical evidence, or that is my probability. Now we'll get there in a minute. Volume spike has been subject of many research paper, because it's a very important information that traders around the world would like to use. So it has been a subject of a lot of research around the world. I'm just pulling together a few examples for you to have a read of whenever possible, but just for the purpose of information. So for example, here is one from Japan. You can note down, or you can have a look at the paper. It's available in public domain. You can download it from the internet to read. There are several from USA. Here is one from University of North Carolina, and there is another from USA, that from University of California in Berkeley. More from USA. So Sapphire Technologies' proprietary volume spike trading algorithm, basically what it does is it analyzes the historical data, and then it finds the number of occurrences that had happened, so number of spikes that had happened for each of the underlying, for a particular for index, and then it finds the patterns around it. For example, what happened after the spike, after a volume spike in over a period of time. It identifies the opportunities, trading opportunities, by looking at the size of the volume and the price movement before and after the spike, and also it spots the historical high. So what happened after the spike, how far it went up or how far it went down for each occurrence of the volume spike. And you can have a complete visibility of everything that had happened for the stock after there was a volume spike. Um, and you can search for your level of confidence. So basically, what it does is you input certain information here. This is the application that Sapphire Capitals has developed, in which you can input the country, you can input the index, you can select various parameters here, and it gives the number of the spikes and the historical performance of this particular stock. Now, you can also pick a single stock if you want to see how many spikes had happened, what are the spike patterns of that particular underlying, and all this stuff. So using a different input screen, but you can go to that input screen and then pick which option you want to pursue. Do you want to see a whole index full of stocks to see if there is a volume spike, or you want to pick only one stock or one ETF to see what was the volume spike information or the history for that underlying over last, say, few years? So once you do that, then it comes up with a report such as this one. Now, in this report, you can see that this is an example of India, and I'll come to you in a minute as to which countries this application is available for. But in this example, we just picked Nifty 100, which is one of the indexes traded in India, and it listed the symbol, name, industry, the current price, the volume, and the spike. What was the spike happened? And there were, for example, Ashok Leyland automobile industry. It had 12 occurrences for a certain period of time. It had a 60% confidence. That means 60% of the time it had gone up, because we are looking for buy opportunities. If you look at the upper left corner of the screen, average move up was 12.09%, and the average move down was 11.36%. Likewise, it lists the whole number of stocks available for when you run this scan. So the point here is that you don't have to monitor each and every stock. The application, as you run it, it provides all this information for you with complete breakdown of the statistics. So this is just the what do you call it? The initial report or the summary report, and there will be a detailed report. So this is the first page of the summary report, and then you can look for more information for the detailed report. So detailed report looks something like this. At the top of the detailed report, you have a table which gives you, here is an example of iShares Motor, symbol iShares MOT, is a part of the Nifty 100 stock. In 16 trades, there were 10 were winners, 8 were consecutive wins were 8, consecutive losses were 2. It had a 83.33% winning. The average trade length was 61.5 days. Most profitable year was 2020. And the other key interesting information is on the right, which is gross profit, which is 29,470 rupees 50 cent, which means that if we had bought one stock in each of those 16 opportunities over a period of time from 2015 to 2020, then your gross profit would have been 29,470 rupees 50 cent. And in those, there were two losses. The loss would have been 3,997 rupees, making a total profit of 25,473 rupees 50 cents. The largest win being 4,550 rupees, and so on and so forth. So this is the top of the detailed report. Now, you can drill down each of these stocks listed in the summary report into detailed report. First, the top of the detailed report you just saw, but now you can drill down even further. For example, here is the table that particular stock, what happened for each occurrences of the spike. Now, look at the number 1. So that spike had happened on 25th of August 2017. The spike was 10.62 times of the average volume. And the stock had moved 12.96%. The maximum was 16.28, and maximum move down was 0.00, which means that it was a great buy opportunity of the underlying stock. Likewise, if you look at it, you can see the impact of the spike. It had gone down on only on one occasion in this particular example, that 17th of October 2018, when there was a 6.3 times spike. The stock had gone down to 17.02%, but it still did go up to 9.56%. So likewise, so that gives you the detailed report. Now you can also go visual to understand how does the performance look like. For example, this is the line chart. So for every spike that had happened in the year of 2018, there are 5 spike had happened, and the result of the spike is as follows. And this is an example of another Australian stock. Just as an example, these are not the final ones, just for the purpose of you to understand how the visuals of the stock of the application work. So we picked this one for the purpose of your understanding. So this is the line chart, and then we've got histogram, which essentially summarizes that as many number of spikes that happened, how many times there was a winner and how many times there was a loser. So in this particular example, there were only 2 losers, and every other volume spike ended up being a winner. And then finally, the candlestick chart. So in this particular example, you can see that the spike of 13th of December 2017 translated into an upward movement, and you can pick each and every spike from the select event date box, and you can see what was the result of that particular spike, or how did the stock move as the spike, following the spike. So this particular application is available for more than 20,000 underlying stocks in 4 continents, 20 countries, and 40 indices. The main countries covered are in Asia, Europe, Oceania, and America. And you can see that all the major stock exchanges are covered by this application. For more information on this, you can go to video blogs. This is one of these blogs, and it will be posted there. So what we suggest you do is that you trade with probability, and probability not based on hunch, but based on science, mathematics, and statistics. The one that we just demonstrated to you, that these are real tested historical evidence of what happened after a spike, after there was a spike in the underlying stock or ETF. So that should give you a confidence that, okay, every time I'm making a decision about a trading, that these are based on certain historical performance, not based on my hunch, or not based on certain market indication, but mostly based on, not mostly, completely based on the historical performance and the reports that tells you the average moves stock up and down, and every parameter of interest to you. So this gives you discipline in trading. So we would say that to trade with discipline, and most importantly, of course, there is no guesswork. It is a purely based on numbers, and your decisions are scientific, based on historical performances. So, but before we close the video blog today, I want to take you to the page where you have more information about the application. For example, this is the page that you would like to visit, which is sapphirecapitals.com/volume spike trading, and in that page it tells you you can watch the video and know just summary information about how the volume spike trading works. You can read more information on the feature of our volume spike trading application. What does it mean? Gives you more information. Why is it important to you? And then, of course, the screenshots of the application as you log onto the application with your username and password. So I would like you to have a read of it, and then ask any questions. You can write to info@sapphirecapitals.com, and all these details are available at the bottom of this page. I would suggest Please note down our social media information at the bottom of this page, and you can also write to info@Sapphire Capital for more information. So thank you. I hope this information was useful, and we will post more videos in the video blogs. But the intention is that traders in the financial market make decisions based on scientific approach. They use numbers. It's all a number game, and the most important tool that's in the position of a trader is probability. So if you trade high probability trades, take high probability trades, then you have a higher success rate, and with proper reward risk ratio and a probably higher probability trades, you couldn't go wrong. So please visit our website, read the pages, and any questions, comments, please email to info@sapphirecapitals.com or reach out to us via WhatsApp or via email or via social media. Thanks for your time. Have a good one.